to it. Hey, meeting is now streaming. All right, here we go. Hi, I'm Dawn Connors, Mortgage One.
Hello, everybody. I'm Peter Toering from Coldwell Banker. We're happy to be with you.
We're excited to have you listening and watching our program tonight. Thank you for viewing.
Yeah, and we wanted to say, I think first and foremost, I've said this before, we want to make sure that everybody out there is staying safe and healthy. I know things are, getting a little bit crazy, going through quarantine here, and also just a huge shout out and thank you to all of our first responders, medical personnel, everybody that's in, all of our essential workers, grocery store people, truck drivers, everybody that's out there making sure that Dawn and I can record Facebook videos from our offices. So, which is awesome. And we wanted to give you a heads up about what's going on out there. So Dawn, I know that you said like right before we went live that we had some big changes today and things are a little bit more stable. What's up?
Okay, all right. So last week I had done a Facebook Live segment and things had really hit rock bottom. Lending criteria went from minimum 580 credit scores to some mortgage companies 680, and Chase Bank is at 700 scores. Well, our lending criteria went from 580 to 640, so that's a big change, and that has continued. However, the interest rates actually got really terrible between a 640 and a 679 score. And currently, the rates have come back if your score is greater than 660. So lending criteria is stiffened up all the way to 640 minimum credit score requirements, and very, very good interest rates start at 660 credit scores. So I would say that those are like keynote differences between post-COVID and I'm sorry, pre-COVID and now.
What are we looking at as far as an actual difference? You said, that 640 to 660 and 660 up. We're talking big differences?
Well, I just had a client right before this time, and his score is 655. And if his score goes up to 660 with FHA, for example, it's a difference between 3.875 in an interest rate, 3.75, and 3%. So 0.75%, and a difference of $3,000 in closing costs. Huge.
Oh wow. Okay. So it's really worthwhile. And so I assume that we're going to be working with buyers to make sure that if they're on the cusp of that, hey, they're in the 40, 650s, that seeing if there's any kind of are there any like last minute rescores that can be done or some kind of quick fixes? Obviously that's kind of an individual basis, but if you're on the cusp there, we want to really make sure you're over that 660 hill.
Yeah. So how you do that, you kind of lent into that by saying rescore. So that's what we talked about today with our client. So they're at a 655 credit score, and I ran a credit analyzer to see how they could bounce their score from 655 to over 660 because it makes such a difference. And by paying down one credit card with a balance of $4,400 to a balance of $1,600, it will increase his credit score. So we put a strategy together because he has $5,000 or $6,000 in the bank, that he's going to do that about 3 weeks before he closes on his home. So making sure that his home is going to close, and then he'll pay it down so that he can go and purchase his next house with a higher score.
Okay, and like you said, it could also cut off some dollars on his closing costs. So really, some of these paying down credit cards could actually pay for themselves or close to it.
Yeah. Well, $3,000 lower in cost. It's pretty big.
Yeah, that's big.
Yeah, for sure.
So, one quick thing to everybody out there. If you have questions, we're live, and one of Dawn's awesome staff is watching questions. So we are certainly more than happy to answer anything. If you pop in at any time, you can ask questions at any time, and we'll make sure to answer them. And they don't have to be necessarily related to the exact thing we're talking about. It can be any mortgage or real estate related question. I know there's a lot of uncertainty out there. Obviously we've got some pretty crazy unemployments and layoffs and furloughs. So let's say somebody is starting to look for a house right now, and they get this. We had just an absolute tragic moment a couple of days ago too with one of my clients. They got that same notice while they're in a deal. What happens, and what do things look like if somebody is unemployed, laid off, furloughed? What's the story there?
All right, great question. Okay, so a couple things. If your pay has been temporarily reduced, even if it's temporary, we have to use that reduced pay for qualifications. So let's say you are a $100,000 income earner and you received a 20% pay reduction. Now your pay is $80,000. That's the income that I need to use to qualify, even if it's just for 90 days, or if that's your current pay, that's the pay that's being used. In regards to furloughed or receiving unemployment, not working because you're getting unemployment, you can't close on a home until you're back employed. So an interesting conversation I had today, I had a client that was unemployed and they got called back to employment, even though they didn't get called back to work, because their company received government money in which they will continue to pay their workers so that they get reimbursed from the federal government. So in their case, they were unemployed and now they're getting their first paycheck next week. And I'm able to continuing to process and close their loan now. So whoever is out there that was on unemployment is now getting paid, even if you're not back to work per se, but technically you're a reinstated employee. I can close your mortgage loan.
And that's how quickly can that be done? Once, is it, hey, we need a pay stub? Is it just something from their employer stating they're back to work? What exactly are you guys going to need?
Yeah, employment verification information is sufficient, and usually a pay stub works well too. Especially if I needed bank statements and I saw unemployment, then I probably would need a pay stub.
Yeah, and that's the big thing about this is obviously with Congress passing, and the numbers of course escape me, but I think I can't remember if it's 350 billion or if that was the first one, but with kind of the second refunding of this Paycheck Protection Program, I think hopefully there will be a lot of people that were on unemployment or that were laid off, that even if, like you said, they're not back to work, hopefully that, because I believe that if you're receiving federal aid, you have to keep on 90% of it's either 90% of your staff or paying your staff at 90% of their wages. And I should know that, but it is one of those two. So we're going to see a lot of employers, I think, hopefully bring people back. I know UAW has said they're hoping to get some people back to work fairly soon too. There's also, I know, some big changes for self-employment.
Yes.
If you are self-employed, tell me the story there.
Woo, you've read right into my mind. I was thinking we need to talk about being self-employed and how that works. All right, so a few different topics we need to talk about. Number one, if you're self-employed and you're not essential, you have to prove that you are working. Like I have a client that's a doctor that is essential. It's obvious that even though she's self-employed, it's obvious that she's essential and she's continuing to work. And when we call her, she answers her phone. I have another client that owns a counseling center that when we call them, it says, even though we are not answering our phone, we are working. We're streaming. We're doing, not streaming, but doing video counseling. And so they're continuing to work. I have another client that owns 2 car washes. Those car washes are closed. So those, in that case, they cannot proceed until their doors are reopened. And if you are told specifically that you can't operate like a real estate agent currently, then you can't lend. And so you can't close on your loan. So that's kind of a nice segue, I think, into you, Peter, at least in a couple minutes, anyhow.
Yeah, and the one real quick question on that self-employment. I know that there were, if you are self-employed, you may start wanting to put together a little bit more documentation, kind of have your ducks in a row there. I think they said P&L. I just saw a question here. Shelly, what if you're on 1 week? I think it's if you're working 1 week and 1 week you're off on unemployment. So is this? I'm not 100%
so
sure. So
Shelly's asking, hi, Shelly. So Shelly's asking, what happens if you're on partial unemployment? I remember years ago when I was on unemployment, I was returning back to work, but it was slow. So I think Shelly's question is, what happens if you're working 1 week and then not working any hours and receiving your unemployment the second week, and then the third week you're working? I would say it would depend on how your employer answers that question. And I would have to qualify you on that partial employment, on that partial or part-time employment.
And can any of those unemployment funds, if they are working, be used towards, I don't assume so. It's just on the reduced amount, correct?
That's right. That's right. Yep. Yep. So not unemployment, because unemployment is temporary in nature. Whenever you have like a fixed income or a guaranteed income, number one, it has to be guaranteed to continue into the future for 3 years. And then you have to have some sort of legitimacy of having it in the past, or have it fixed into the future. For example, child support or alimony. If you have guaranteed that you're receiving it into the future of at least 36 months from the time of closing, I can use that as income. If, however, your child's 16, they're aging out at 18, and you won't be receiving the child support anymore, then I can't use it as income, even though you're going to be getting it for another 2 years.
Sure. That's actually, speaking of this, kind of goofy funds, the stimulus checks, are those, let's say that you are wanting to use it, your stimulus check towards your closing costs, your down payment, is the fact that, we can see that it's a, Treasury Department direct deposit good enough? Is it treated like a gift? Is it treated like income from like an underwriting side? I know that's kind of a little bit off the weeds question. But I know, just like your tax return, a lot of people use that towards their down payment.
Sure. Just like tax return, that $1,200 can be used towards down payment and closing costs for sure. Can't be used as income, but it's used as, and no gift is needed. It's your money. Right. I guess it's technically your money. So, yeah.
Right. Okay. So no like kind of extra documentation, which is good.
Right.
And the other thing too, I know that, especially with rates being just as crazy as they are, we were seeing just a glut of refis beforehand. I know now that what has changed in the refi world. I know that some places have stopped doing cash outs. I know that the rates are kind of all over the place. What's the story there?
Yeah, there's definitely some stiffening up in guideline changes there, but for Mortgage One, for example, we haven't had any changes as far as cash out refinances, or the only change that I've seen is appraisals, which will probably lead into a conversation with you and I in a minute on appraisals and discussions on what you've seen. Today was the first time that my interest rates will stay open until midnight. So I like to talk a little bit about that because that's a huge change. For years, our market for locking loans closes at 8 p.m. Eastern Standard Time. So because of COVID, go ahead,
John,
Peter.
Explain what locking your rate is for those that may not. I mean, you and I are using that every day, but.
Thank you. So when you have an accepted offer or you are refinancing, at some point your loan officer needs to lock in your interest rate or buy that interest, like lay a hold of that interest rate and claim it for you. So that's called locking in your interest rate, locking it down, locking it in. And typically interest rates are locked for 30 days is what's average. There's been so much volatility in the market because of COVID that started in the beginning of March, that on March 5th and 6th, interest rates hit an all-time low of approximately 2.75%. And then within 48 hours, interest rates hit 4.75 to 5% the whole following next week. It was insane. And then they went back, ratcheted back down, and then back up and back down. It got so volatile that our mortgage department, the lock department, would close early, sometimes at 3 o'clock in the afternoon, saying, okay, there's no more locking going on after 3 p.m. because it just got too volatile. And then,
real quick, for people that aren't understanding how big of a swing that is, I mean, if we went one interest point one way or the other in what, a month or two, I mean, that would be a huge deal. And to see we're going from 2.75 to 4.5, so almost 2 points. I mean, it's just a huge swing.
Yeah, 2 point swing is $150 a month in payment for a $100,000 home. So it's a big, giant swing. Thank you, Peter. Again, thank you. So, so today we got notification that markets are settling, and the fact that Fannie Mae and Freddie Mac and the government are buying mortgage-backed securities on a even keel basis has allowed for the most tamest mortgage environment that starts today, and that will prayerfully continue until this whole pandemic is over. And this is allowing us to keep markets open until midnight. That means that I probably, after this call, will be locking interest rates and looking to lock interest rates, because you never know what tomorrow is going to hold, and you don't know what money's going to hold. Markets are always closed over the weekends. But to be able to, I've never been able to lock an interest rate up to midnight. It's always been 8 p.m. has been the cutoff and then the market shut down. So that tells us that everyone's safe enough to feel like they can go to sleep while I'm still up locking loans, for example.
Yeah. And that, I mean, that's huge. You know, not only the fact that you weren't able to do that during this, you know, COVID crisis, but also you hadn't been able to do that previously. So that, I mean, that just seems like just fantastic news on, you know, on the mortgage side of things. I also know too, let's actually talk about appraisals, because we've had, tell me what you've seen on your side as far as appraisal waivers, as well as, you know, we've seen drive-bys. We've had some issues with appraisers taking on a lot and, you know, being worried about values. What have you seen on your side of that?
Yeah, so appraisers are squeamish about going in people's homes. Usually the appraisal will get turned down by 5 or 6 people before an appraisal will take the order, will take the request. Typically, the appraiser does not want another person in the home at the same time. They're only in the house for about 10 minutes, quickly taking photos. They usually wear gloves and masks, and they're going into the house, doing what they need to do, and then getting out without touching a lot of stuff, just going through the rooms, taking their photographs, doing what they need to do for their inspection, and then out, all within a matter of 10 minutes. So I'm seeing value shortages. So we have to remember, we're in the middle of a pandemic and there's no sales going on, or very few sales. So we're now at about 1 month into this. So there's not really good comparables in the last 30 days. The comparables are 30 days plus out. And the longer this goes on, the less data that an appraiser has. And in the middle of an appraiser carries what's called errors and omissions insurance. They don't want to be, they're concerned about their license and about over appraising a property as well. So they are definitely appraising properties conservatively. Those are for the ones that are in, there's 3 different types of appraisals. There's a drive-by appraisal, which an appraiser drives by the property, takes photographs of the inside and outside, does an exterior inspection. There's a desktop appraisal, which literally someone's just sitting behind a desk, viewing things on the computer and running comparables and doing a full appraisal report based upon what they see and they get from their computer. And then there's a full interior inspection, which an appraiser knocks on your door, goes inside the home, spends 10 minutes in there taking an interior, exterior photos and doing a visual inspection of the place.
And that's real quick, got another question coming in. They're asking, what is your kind of current mix? What are you seeing refis versus new purchases as far as kind of percentages there? I'm sure there's a lot of refis.
So if I understand the question, I'm kind of looking at it too. What's your current mix and pipeline, refis versus new purchases? Mary has a great question. That's Mary writing. So I've always been 70% purchases, 30% refinances. I am 80% refinances, 20% purchases. And if this continues, it's going to be 90 and 10 very soon. So $7 billion of refinances have already taken place, and it's estimated that there's a possibility of $3 billion more dollars of refinances. So 70% of refinances have already taken place. That's pretty massive. And so we're going to start to see refinances fall off. So even though lenders have been extremely busy these last month and a half, that is going to change, just like it's changing for real estate agents if we don't get back to opening up our purchase and sales market.
Yeah, and real quick too, what percentage are you seeing? I was talking to another buddy of mine who had mentioned that they were seeing a lot of appraisal waivers or a lot of deals that were eligible for appraisal waivers.
Sorry, I didn't say that. I didn't say that, did I, Peter? Thank you. You're good. Okay, so a 4th category, which Peter is so graciously telling me about, is you don't need an appraisal at all, because the automated underwriting system accepts the value that is input by the loan officer or by the purchase agreement. It's called a property inspection waiver. And it always says, it says specifically in the notes, if the lender executes the property inspection waiver, then Fannie Mae or Freddie Mac accepts the value as is. Otherwise, if they don't accept it because they still want to option for a full appraisal, then it's not being used, and then the person can still do a full appraisal. So Peter, your question was, what percentage of PIWs, principal inspection waivers, am I getting? Well, on refinances, I'm trying to give them on 100%. If some person's not cashing out refinancing, I'm pretty ticked if I don't get a PIW, a principal inspection waiver, on a rate and term refinance, and somebody's not pulling out cash. So that's going on, probably 85% probability I'm going to get that, 85%. On a cash out refinance, if somebody's taking cash out, there's 0 probability of getting an inspection waiver.
Right.
And if it's a purchase and it's conventional, I'm usually getting a property inspection waiver. But if it's a government loan, if it's MISHDA, if it's rural development, at least at a minimum, they want a drive-by appraisal or a desktop appraisal.
Yeah, that seems right. One other thing that you really, and I want to jump back to real quick, that you brought up with appraisal is the lack of comparable sales. Obviously, an appraiser wants something that's as close and as recent as possible. And, you know, just a couple of the quick numbers. So normally in Macomb County, we have about 2,400 deals or so. That's what we had in March go pending. So far in April, at least this is according to like my NMLS's market monitor, we've only had a little over 200 go pending so far in April.
Wow. So 2,400, from 2,400 to 200. And what county is that?
That's in Macomb.
Macomb. Okay. What's the statistics in Oakland County? Are you able to pull those up?
Yeah, I can. It might take me a real quick second, but it is the other thing to note too is now if we, you know, traditionally once the weather starts to warm up, we have number one, a big swing in inventory that goes up, and we also have a big swing in sales that goes up. So it's a lot easier to appraise a house there's going to be a lot more counts available in April, May, and this is going to be a problem for appraisers going forward, because in May or June, you don't have any of these March sales. And you're also looking at, our market is traditionally a little bit slower in the winter, and that's what the appraisers are looking at, is these January, December, November sales. And that's going to make things a little bit tougher.
Yes,
Oakland
that's
County
a good point.
is normally at about 3,400 pending deals, and right now they're at, I'll get that number for you too. And that's going to, everything in real estate, as you know, is a lagging measure. So, you know, when we're looking at numbers, we're just now seeing the numbers from March. So we really don't get a clear picture of how this has affected the real estate market, at least in sales. Oakland County is about 3,400 normally, and about a little under 500 this month. So I mean, these are big declines. Same thing in active listings. You know, a lot of people, I know certainly my clients, are holding off. Some are wanting to get virtual tours done, and we'll talk about that a little bit later, but a lot of people are kind of holding off.
So how many homes are active right now in Macomb, Oakland, even Lapeer, whatever you know, for those counts?
So that's the one nice thing that we do have, is we've got quite a bit of kind of older inventory. So there's 1,500 houses on the market in Macomb, which is less than normal. And in Oakland, there is 2,800. So that's still a decent, so don't be, you know, too worried either if you need to move right now, because some people do. You know, you're either moving in for a new job or you're moving out. There's still inventory out there, and there's still people that need to sell. Can we go into that real quickly here about how that actually kind of works, and then we'll
I'd love that.
Yeah, and then we can jump back to, I have a couple other mortgage questions too. So let's say that you do need to sell your house right now. It is legal to do it, but everything has to be done from your home, meaning that if you were to call me up and say, hey, Peter, I've got to sell my house, I can put it on the market for you, but my problem is I can't send my photographers out, my videographers. I can't come see your house in person. I can see, you know, on Zoom. And the same thing with buyers. Buyers can see your house if you record a Zoom video walkthrough, but they can't physically come to the house, and the agent can't physically come to the house. So what we are seeing is a lot of these deals that are going pending are going to be on contingent upon a physical inspection of the house later. And actually, hang on, I just saw a couple of things. Let's actually pop to these questions while I got them. Forbearance, do you have any new news?
Yeah, Shelley's asking about forbearance. Yeah, I have a little bit of new news. So I kind of grilled a client today of mine who I had lots of questions for her because she entered a forbearance agreement with Wells Fargo in which they told her that she would have 3 months without a payment and they would put the payments behind in the back of the loan and they would not report the lates to the credit bureaus. However, they will be putting on the credit report forbearance proceedings started, and it will affect her credit score. So she started this about 2.5, 3 weeks ago because she wasn't sure, would I get my unemployment checks on time? And this was also the same woman who actually, her husband is getting called back into work, not to work, but he's the one that's getting those checks that are coming in. So they don't need the forbearance anymore. They weren't sure that they would need it, but she was more concerned of, if I don't take it, then what are going to be, will I lose the opportunity? So if you enter in forbearance, you can still option to make the payment. So she called me today to see if she could refinance. If you are in forbearance and a month passes, you can't, and you would now have the equivalency of a 30-day late, you can't come out of that forbearance. So she called me at the right time because it's April 23rd and she still has time. She still has a week to make the payment. If she does not, if she makes her payment, which she has the money to do, I can get her interest rate reduced with an FHA loan down to 2.99% without any closing costs, because she has a pretty good sized loan amount of $250,000. So a free loan at 2.99, and she'll skip a mortgage payment and she'll get her escrow money. She'll bring her escrow money to closing and get it fully refunded. So nothing, basically zero out of pocket costs, no closing costs, and an interest rate of 2.99. She is seriously she's probably going to send in her mortgage payment and pay it over the phone and proceed with this, because what's better, saving $100, $150 a month forever, or having 3 payments put to the back of your loan, and you can also skip a mortgage payment in a refinance. So
yeah, that actually brings up, I've seen kind of a lot of yeah, I'll get that. I've seen a lot of questions about people trying, talking about taking advantage of, of forbearance. And the one thing to be careful of is I've seen quite a few that have a balloon on the end of it.
yes,
I'm not sure if you've seen that same thing. So you got to be careful with the forbearance.
US Bank, a lot of banks are doing that. And I asked her specifically that, and this woman's pretty investigative. So she said, nope. They said that there's not going to be late payments, and they're putting those payments at the end of the mortgage. So she'll owe those at the very end. But for example, I know US Bank is having those payments, and a lot of banks are saying, we don't know, we'll work out something afterwards, but 90 days without a payment. And then on that 4th month, you have to make all 4 of those payments.
Right. So definitely be careful if you're looking into forbearance.
Another what kind of plan is that?
Do you anticipate tightenings of either loan to values or of debt to income ratios going forward here?
Tightening of loan to value. Great question, Tony. So no, not currently. There's not tightening of loan to value. I will start saying this: if this goes on 30, 60 days, if this goes on, 60, 90 days, mark my words, the appraisers will have to start commenting if value is being impacted if we're in a declining market. And do you remember, Peter, when we were in declining market, and I know Mary remembers this, where if you enter into a declining market situation, then you automatically have to put 5% more down. And so you automatically go from 5% down to a forced 10% down.
And the thing that makes me nervous there is I know even when the market was starting to go, up, even when I was early in the game, 15, 16, we were still seeing appraisers that were just kind of coming out of those, declining numbers or just out of the stable numbers into an increasing market. Even when we were increasing, 16, we appreciated 13% in 1 year in some areas. So that certainly makes me nervous. What are your thoughts about the second part on debt to income? Do you think those will be tightened?
They should be. It should automatically come from the automated approval systems, where I should not be able to get an approval at 55% debt to income ratio on an FHA loan with a 660 score. It has not happened yet.
Okay. And then I just saw one other comment that's, we're going to get to that in a second. That they mentioned buyers can accommodate home inspectors if they have permission to view the home. Yeah, absolutely, that's true. My comment on if you're willing to offer on a house, a lot of these are going to be contingent on physical inspection. That may be with your agent after it's all over. It may be with the inspector themselves. You know, there also may be buyers that say, hey, listen, I'm not 100% sure I like this house. I'm not necessarily willing to, you know, pay for home inspector just to get into the house. There may be. It's going to be very interesting to see how this affects real estate going forward, on what the new normal is. You know, I know that for myself, I was not, there's a program called Matterport that some agents use that allows you to do a true virtual walkthrough. And I think we're going to see a lot more of that. I think that buyers will want more virtual showings anyways. You know, I don't think it'll be 100%, but.
So Peter, what are you doing now when a person wants to list and sell their home? How are you facilitating like a virtual walkthrough or pictures? What's that look like?
So here's the thing. Part of this too is going to be different brokerages have, you know, handled this different ways on the way they've interpreted this and the leeway they've had their agents to have. So I'm certainly not here to criticize any, you know, whoever is out there doing things one way or the other. Some agents are doing virtual tours themselves. Our brokerage was very, very, you know, as you know, Coldwell Bankers, pretty letter of the law people. And they've said, hey, listen, you can do anything as long as you don't leave your house. So for me, if I've got to have a virtual tour done, it actually has to come from my seller. And then, you know, it can be facilitated through me, through Zoom or another program. But, you know, it has to be the actual seller that's walking through. Same thing on the buy side. So
are you, if the seller's walking through the house and showing the house with their phone, are you speaking about what the seller is doing? So
for us, I prefer not to. What we have done in the past is have actually had the seller record their own video and then upload that. The MLS now has a separate virtual showing option, so they can actually kind of download that video, and that's been the best way to do it. For me, I don't really like having either party, you know, speaking. If we were going to do a live tour, this is just me. I don't necessarily like my buyers or sellers talking to each other. So if there's specific questions, a lot of times I'll follow up with the agent. But yes, it's basically what can be done from your home, which does make things tough. I mean, I know, especially, you know, for me, I had a virtual listing appointment the other day, and I never knew that I got any sort of motion sickness until I'm watching somebody swing their camera around on Zoom. So it can be a little bit more difficult. It can certainly be more difficult on, you know, seeing condition of the property, and, you know, cell phones only capture so much. But also tools like Matterport are being used, and a lot of agents are adapting and still doing some business. And it just really depends on the situation.
Okay.
So, okay. I know that we are also, I am not going to anything in person, so I've got a closing tomorrow that I'm unfortunately not going to, which is sad. It's like, that's, you know, my favorite part of the transaction. I know it's probably yours as well. And it's an awesome celebration, and it's tough to kind of not be there to share that moment after, you know, kind of a roller coaster ride with some buyers or sellers. But hey, we're getting it done. That's actually one thing I wanted to mention on closings. Everybody's handling closings a little bit differently. Some people are doing like the curbside closings. I just talked to my title processor, and that's been a really big pain with buyers, because you're not sitting there to kind of explain things through them, and they're trying to sign all these papers in their car. I know the title company I use a lot of the time, ATA National, is doing, you know, they'll only have one party. They schedule only a certain number of closings per day, only a certain number of, you know, one party in the office, and they're, you know, just keeping everything very, you know, distance and you know, keeping a minimum number of people in those offices.
So have you seen anyone with the governor's change on notaries being able to being done by video? Have you seen anyone doing that, where we actually have video signings?
I haven't needed to yet. I probably will here in a minute, because I've got clients that are out of state. So I think that I will have my first one in the next week or two. But I have not needed. Everyone else has been local, and obviously those title agents are, you know, notarizing things. So I normally only need to hire notaries on out-of-state closings, anyways. So then it's going to depend on what, you know, their state is. But
okay.
I certainly think it was the right decision. I mean, there's no reason not to. There's a bunch of states that have it.
So if you can speak into what Eric Ramo is mentioning, he says that home inspections can still take place and they have permission to access the home. So can you feed into that and explain that a little bit more?
So the inspectors are deemed essential, which it does draw a weird, it does become a little bit weird and a little bit frustrating when we say, hey, wait a minute, my inspector can be there, my buyer can't be there, we can't. It is, but hey, you know, I always tell my clients, we're playing the hand that we're dealt, and we're playing it to the best of our ability, and that's all. I can't change what cards are dealt to us. We just change the way that we play them. So yeah, they certainly can. You know, the home inspectors are going out. A lot of the home inspectors that I have talked to don't necessarily want the buyers with them, so that's also going to change. But you know, inspector to inspector. But legally, yeah, the buyer is allowed to be there if the inspector and the seller are both okay with it. Of course, you still have to have less than 10 people, and they still want you to kind of be social distancing and all that fun stuff.
So Peter, am I right in saying then the buyer can attend the home inspection? Is that
yeah, as long as it's okay with the seller and with the I'm not an attorney. We might be getting a little bit murky into like everybody is kind of taking this a different way, but yeah, as I understand it, yes. And it is, I know that I actually saw in your show notes here that you know, there's a company out there that will, and we'll plug them in the comments. We'll link to them. Gold Shield, that if they just don't like the house within the first 20 minutes, it'll only be a $75 charge. And this is also going to be interesting to see. I am not somebody that believes that the value of realtors is just in opening doors and showing property, but it is going to be interesting to see if that showing model will change at all. So that's going to be interesting too.
What do you mean, Peter?
More so just in, hey, are we, especially if these social distancing measures go on for longer, are we going to have, is it going to be not the new normal, but is it going to be more common for a buyer to write with only having seen a Matterport tour or a visual tour, and then maybe they do go see the property with or even, you know, let's say a buyer was going to see 15 houses, maybe they see 25 on virtual tours and they only go and see 3 or 4 in person. It might streamline the process too. I think too, a lot of it's going to depend on how well agents adapt and what sort of tech tools that we start putting in place. Like for me, I know that I've talked to a lot of people that are not big fans of Matterport. I think it's awesome, but it is expensive, and that's why it was adapted for some of the higher end markets first.
What is Matterport? What is Matterport, and what does it typically cost?
So what it is it's actually where you can, and I'll post a link to it. You can actually click and walk through the property and see it from kind of every angle. It's almost like a 360, but through the entire house. And then you can kind of back out and see a dollhouse model. It's very cool. And I think just like everything else, just like originally drones were unbelievably expensive, they're only being used on multi-million-dollar properties. And as the technology's gotten better, that's kind of filtered down. And I think the same will happen with some of these virtual showings.
Right on. So Steve Unruh would like to give you a shout out. He asked, what's the difference between creative financing versus traditional financing? Is it okay, Peter, to kind of move towards that question?
Absolutely.
All right, Stevie. So Steve is an investor. He wants to know what's the difference between traditional financing versus creative financing. So let's talk a little bit about that. A traditional mortgage has guidelines set forth by typically Fannie Mae and Freddie Mac. So there's government loans, FHA, and they have their set of guidelines. There's veteran loans for VA buyers, and there's rural development loans. Those are all home buyer programs that you have to own and occupy the home as your primary residence. Conventional loans have options. You can either live in the house as your primary home, live in the home as your secondary home or vacation property, or 3, buy a non-owner occupied home as an investment property. So Steve is wondering what's the difference between a traditional mortgage and the non-traditional. So a traditional mortgage is typically those that follow the guidelines of Fannie Mae and Freddie Mac that say usually the guidelines are you have to be 7 years outside of a foreclosure, 4 years outside of a bankruptcy, and your debt to income ratios have to be under a certain percentage of 45%. All of your income has to be claimed income that you can document by tax returns, W-2s and the like, Social Security award letters and the such. And a non-traditional mortgage is, for example, a portfolio loan. So there's almost three categories of loans. There's the best interest rates that occur happen with those Fannie Mae and Freddie Mac loans because people fit into that box. So if you fit into that box, that's a conventional conforming loan. If you don't fit into the box, the second category would be portfolio loans. Perhaps you don't fit into the box because you are buying a condo that doesn't qualify for Fannie Mae lending, or you are beyond the loan limits of $510,000, so you need a jumbo loan, or usually those are usually the main reasons that you would need that middle box where the interest rate's a little bit higher. And then there's a third category that's called hard money or specialty financing. And let's say that you want to buy a property that's worth that's for sale for $100,000, and you're going to flip the house. So you're going to improve the house, and let's say the after improved value is $150,000. Hard money lender will lend to you 75% of that $150,000. So virtually you could have no money down. You get that hard money loan at a higher interest rate, and typically you have to pay that money back within 12 months or less. So that would be definitely a hard money loan or a non-traditional mortgage versus a traditional mortgage where you close the loan, you have a principal and interest payment, and once you pay it off, it's done and closed. Where hard money is typically for a short period of time with a higher interest rate, and it's perhaps because you can't get the money from any other source. One more thing, typically a hard money loan, you don't have to document. You're not really documenting income, but typically on a hard money loan, you do have to be pre-approved for the end financing. So you need someone like myself to be able to say that after this house is restored or after they do this and this, they do qualify for a traditional mortgage. I hope that answers your question, Steve.
Hey, Dawn, the one thing that actually brings up for me is, are you seeing any changes to some of those, like some of the hard money lending, or I know we also talked about jumbo loans. How are things changing kind of outside of the traditional mortgage market?
So if I hear your question right, you want to know how things are changing outside of the traditional mortgage market. I guess I don't still follow. What do you mean?
Okay, so obviously we know there's some restrictions, some tightening of qualifications on regular mortgages. Are we seeing those same thing? Are we seeing any massive changes? I know that we said we're going to talk a little bit about jumbo, and then also, are there any changes are any of these hard money lenders or any of these portfolio lenders kind of tightening the belts too?
Yeah. Many, I don't want to give specifics on bank names because it's hearsay at some of these. Many banks have stopped lending on jumbo financing completely. Like they put a moratorium on a jumbo loan. A jumbo loan is if you need a loan amount greater than $510,400 in Michigan, you need jumbo financing. And there's zero interest in those loans right now because there's no one buying those loans. They're not being able to be securitized or purchased on the stock market, on the mortgage-backed security, because basically the only one buying loans is our federal government, because our mortgage-backed securities are not desirable because the fear is what happened in 2008 is it could reinvent itself. So basically, if you don't fit within that bucket, that large bucket, then you're left out in the cold right now. So many banks are not lending on jumbo loans. We are, but many are not. And so I actually had Michael Blake contact me this week to ask me jumbo loan questions because his bank that he normally likes to work with is not offering them whatsoever. The other interesting thing is doctor programs. What have you seen, Peter, on the doctor loans? I personally have had a stop to doctor loans for the short term. What have you seen?
Yeah, I've seen the same thing. I've only talked to a couple of people. I've seen kind of the same thing, at least. From the limited amount of, there's not very many people that do. There's a couple of different, and I know we've talked about this, there's a couple of different doctor loan programs. There's not that many people that do them. And the ones that seem to, like some of the credit unions are kind of tightening the belt anyway. So that seems to be something that we're going to kind of have to ride out. One other quick question too. I know we've got some investors, I'm sure, that will watch. Obviously, with things being a little bit volatile, this is kind of a crazy time to look for something to flip, but I know people are out there getting deals and doing it. Are you worried that they may have trouble obtaining financing on flips or on flip to rents, buy and hold, anything like that?
So Michael Blake had a client that had a gutted house and was going to was in the middle of his process to refinance it, cash out basically for a construction loan. So basically $250,000 was going to be placed in an escrow account. I think it was more than that, but let's say it was $250,000. And he was just to the point, his client was just the point of closing, and they canceled the loan on him because they're concerned that it won't have the end loan value. And so they refused to facilitate the closing. So yeah, that's a real situation that did happen in the past. So you have to be real careful, because if you're doing hard money loan, let's say you're doing a hard money loan, you have 8% interest rate, and you've got the loan for up to 12 months. If values go sideways and you can't, and you don't have if the value is not 150,000 in 8 months, when you're 6 months, 4 months, when you're done with the house, that would be problematic for you.
Right. It's certainly something that I've encouraged any of the folks that I've talked to that are investing in, at least, be careful, not say people. I know there's a lot of awesome investors out there getting things done. Another question I just saw, shout out to good buddy of mine, Dustin, and he said, talking about getting rid of PMI. Obviously when you refinancing, I know too, I know a little bit about his situation. I know too, these low appraisals on refis can be problematic. There's also, is this going to change the way that PMI drops off at all? Is it going to change anything like that?
So I had a client that bought a house in 2017 for, I think it was $315,000, and I did not.
It was 200. It appraised for 215, but he had good memory though, Don.
What?
He was 200 and appraised at the time for 250.
Okay.
Yeah. Good memory,
okay. So you want to know what the options are for dropping off PMI insurance?
That's what it sounds like.
Okay. So options. If you're in an FHA loan, you have to move out of an FHA loan into a conventional loan. So you literally have to refinance. If you're in a conventional loan, you do not have to refinance. And some mortgage companies give a lot of pressure in trying to force you to refinance, saying you can't drop PMI insurance. It is not true. You can send out an appraiser hired by the mortgage servicer. They can appraise the property, and you can drop your PMI insurance like that. I have a client that just applied with me that bought their home for in 2017 for $315,000. That was my example. So he purchased for $315,000, and I really didn't want to send out an appraiser because I'm too nervous about it. So I ran automated approval to see if he could get out of PMI insurance with 20% equity. So I ran findings for both Freddie Mac, for Fannie Mae and Freddie Mac, and didn't get an appraisal waiver. I ran it at 10% equity, and I got an appraisal waiver on Freddie Mac's site. Then I ran it at 15%, and I got an appraisal waiver. So his PMI insurance is going to go from $158 a month to $45 a month, and he's getting a total of $9,700 cash back. He'll be getting, Freddie Mac allows for 1% cash back without it being called a cash out refinance. So he's going to get $3,100 from that, from his refinance. He'll get his escrows refunded to him, which are $4,400, and he's going to skip a mortgage payment for a total of $9,700.
That's awesome.
Without an appraisal. He won't need an appraisal, and he's dropping his PMI insurance, and he's going from 4.5% to 3.25%.
That's killer. It's killer. If you guys are out there and haven't talked to somebody about refinancing, you need to do it. So, I think, I'm sure that there are people out there right now that are getting refis that are having issues with these appraisals. So you're saying, even let's say that you had a refi now, appraisals are coming in low. You can always, in 6 months, when this, hopefully is past us, you still kind of go back out, have an appraiser out, and still drop off that PMI.
Sure.
So there shouldn't be, so these low appraisals, or at least that we're seeing some of them, should not be a worry for anyone who's thinking about getting a refi right now.
Right on. And if those who are out there listening, Kristen's going to post out our HomeSnap link. You can apply right through that HomeSnap link, and then I'll set up a time to talk with you to give you specific quotes. If you fill out that information, it's very useful. Even if you fill out just the first phase, as far as you feel comfortable going through the loan process on that HomeSnap application, it's great because it'll allow me to put your loan options together for refinancing. So
yeah, and I'll also put out on, just as far as if anybody that is watching this is looking towards, hey, I like a lot of my clients, hey, I don't necessarily want to list my house now, but I'm ready to jump in when this stay-at-home order clears and people can actually see my house. I will actually put a link out with just like where you can put your address and your name. We'll get you what we have an idea of value for you, and then also we'll keep in touch, and you can, at least as long as you walk fairly slowly with your camera, take me through on Zoom. We can. I think that there's going to be, because this segues into the last thing I want to talk about, which is what do things look like when the cloud, at least most of it, kind of lifts off and things are, maybe they're not 100% back to normal, but things are at least operating on some scale. Where do you think interest rates are going to go? What do you think is going to happen to your refis and purchases?
Well, they're going to dry up. The refinances anyhow, not the purchases, but the refinances are going to dry up. President Trump had eased off of what's called quantitative easing approximately 2-3 years ago, in which the printing of money stopped and the rising of interest rates began. And the purpose of that was to try to get our economy more to a free market economy in which the supply and demand and the trends of a normal cycle takes place. And so you have a little bit of inflationary periods and deflationary periods. Right now we have a deflationary period, or very little. Well, we had very little unemployment and very low inflation. The only thing we have now is very low inflation, and that's because we had quantitative easing that has started back up. So during the Obama administration, there was trillions of dollars being printed and interest rates were being suppressed by the government buying mortgage-backed securities. So in this volatile time, the federal government has done that again because we're in the middle of a pandemic, because it's absolutely necessary to keep the flow of money going. And that's basically what keeps an economy going, is the flow of money, or the circulating of money. So so in doing so, quantitative easing means you are printing money, and we're the only nation in the world that's allowed to print money at a basis that we see fit. And then we're buying our own mortgage-backed securities because, quite frankly, no one else will purchase them right now. And so we're repurchasing our own mortgage-backed securities, which are keeping interest rates suppressed. It's not the federal funds rate that was dropped to a 1/4 percentage point a month ago or 3 weeks ago that's dropping interest rates. It's the government saying, we're going to buy bonds, we're going to buy those mortgage-backed securities in the droves until this thing eases up.
And that's actually a really good point that a lot of people, even people in the industry, get wrong, is the Fed dropping rates does not necessarily mean interest rates drop. It is, like you said, the buying of mortgage-backed securities. Do you see that reversing? Do you see the Fed? Do you see, a slowdown in mortgage-backed securities being purchased? Rates going back up? Do you think that it's going to kind of stay where we are and things are going to just kind of stabilize? What are your thoughts there?
Well, it's going to have to. They absolutely have to increase. I don't believe it's going to happen, though, until after elections. I think it's going to be post-elections that this is going to start happening. I think if there was something significant, another significant thing that happened, I wouldn't want to make a couple examples, but war, for example, if war hit, rates would just fly out of control. So there's some things that could happen now that could cause rates to just unleash itself, but the probability of that is very, very small, especially we're in the middle of this.
Okay. So let's say that you maybe had plans to move in 2020 or 2021. You're probably better off bumping those plans in the next, let's say the next 6 months and taking advantage. I mean, these are, historically what some of the probably the lowest rates we've ever seen. They
are the lowest rates. They are the lowest rates that I've ever seen in history. Between March 5th and 6th and today and yesterday, today, they're the lowest that I've seen in history. They are the lowest.
Yeah, so even if, let's say that you've got
the last 45 days.
Yeah, I mean, so I would say, hey, if you're out there and you're considering it, even if you do fall on the high end of things right now, 4.5%, it's still, what were we averaging in 2001, 2002, 8, 9, 10%? In the 80s, we were what, 15, 16%? I mean, so historically, it's just, even if you don't get 2.75, I mean, these are still incredibly low rates, which is just
yeah. I mean, how do you feel about a 3.75 interest rate if you have less than perfect credit? It's like, holy heavens, that's the worst of it. Like, okay.
Right. It's insane. And I think too, I think because of that, I know that the Chinese real estate market tripled when they opened back up. That was a couple of weeks ago. I haven't seen any news on that since. But I do think that we're going to have and again, once again, real quick, we're going to be wrapping this up in a couple of minutes. So if you're watching and you have questions, type them in now so that we can answer your questions. We will go over time, or I will at least answer questions. I've shown a blatant disregard. Dawn, for those of you who don't know,
I'll be out in 5 minutes.
A killer time blocker, and I'm showing a blatant disrespect over time block. I do think that we're going to see just an absolute blast off of the market. I think that there's going to be a lot of people putting their houses on the market, obviously with some precaution. I think a lot of people are going to be jumping in. So right now is not a bad time to kind of beat the rush, I guess. But I don't think that if you said, hey, should I buy a house now? Should I buy a house in 3 months? Should I list my house this second or in 3 weeks? I don't think there's a bad answer. I mean, it's going to depend a little bit differently for everybody. But I think that I'm hoping that we are in for a V-shaped recovery here as far as the number of transactions and new listings and things like that. I think there's a lot of pent up demand.
Peter, can you explain?
Are you seeing the same thing on your end, Dawn?
Yeah, I am for sure. Can you explain a little bit more about the Chinese market when you say tripling demand?
So
can you feed into that more?
As far as I understand it, it was in market activity. So new listings, new pendings, new closings. I don't have all their stats, so it was just the Forbes article or whatever it was, and I can link that out. But so it was definitely because like I said, anytime there's pent up demand like that, we've been building, a dam here, and there's all this water behind it, and as soon as that, it's not going to just poke a couple holes. We're going to just open the dam right up, and things are going to. I think it's going to be a flood of new inventory, which could be awesome for us. I mean, we've been in one of the lowest inventory markets in the last 30 years, from about late 2017 until late 18. We were in a very, very, very low inventory area, and some of our areas still are. So this could be actually the thing that we needed to get some more inventory on the market. I'm hoping.
Peter, what do you see in terms of real estate from one county to another? I know you live in Lapeer County, right? So Lapeer versus, say, Genesee County or Oakland and Macomb. Do you see any changes coming?
Yeah, as far as the rural markets are always a little bit behind, like the appreciation hit a little bit. It was kind of a little bit slower, but I don't see any vast ways that this has impacted. My county that I live in has a lot less, has been affected less by this COVID as far as at least number of cases. We're just more sparsely populated. But from a real estate perspective, I haven't seen values drop off a cliff or anything that, doom and gloom that I was hearing. I haven't seen any of that in any. I work in 3 or 4 counties. Haven't seen it in any of them. So they're all reacting by basically just kind of hunkering down. The market slowed down, but we didn't really see any big changing in pricing, which was good. You're going to see days on the market shoot up for April, but that's okay. It's just going to take houses a little bit longer if people can't come and see it. And
then I'm just curious, one last question from me. What tools do you have that maybe other real estate agents don't use technology wise that place you in a category of your own or head above others? Just if you could give me just a rundown on what you do.
Yeah,
that's different.
I think the basic thought is that right now we can conduct 90% of the business that you need to do in a normal real estate transaction without ever seeing you. So we use video conferencing. We obviously, and a lot of agents, all of our documents are electronically signed. The only thing you'll ever sign is closing paper. But we can facilitate basically everything. We're working on getting virtual tours done with sellers agents, and we're using, a lot of. I've been on Zoom more than I ever have in my life. And it's still great to be able to, I'm using Zoom a lot instead of phone calls. It's just a lot better to be able to actually sit down and face-to-face talk to people. But I appreciate that. And it's been an interesting learning curve, and it's been goofy, but I'm very optimistic for the future. I really am. And one last kind of thing here. I know that I've been seeing your rates. what are your, I know obviously something that is really concerning to sellers right now is being able to close loans and close them quickly. I know that you traditionally have a very fast turnaround time, and that is going to be super important to a lot of buyers and sellers. What are we looking at? What are you looking at for purchase turnaround times? Obviously, refi is not as important.
Right. We have two different train tracks when it comes to our company. So, and many companies don't follow this school of thought, but we have a refinance train track and then we have a purchase train track, and we don't intermix the two because we can still, so typically a refinance will close within 30 to 35 days, except if you don't need an appraisal, then it's 21 to 25 days. A purchase can close within, on average, is closing at 20 to 21 days, and a refinance or an FHA purchase within 23 days. MSHA is at about 35 days. So we're really ramping those turn times big time. So on average, 3 weeks, start to finish.
Okay, which is unbelievable. I know a lot of MSHA loans take 45, 50, 60 days to close. I mean, those numbers are killer. I assume that you are also meeting virtually with people, you're using Zoom and people can still, hit you up and schedule a time. Like,
yep.
Right?
Okay. Yeah, my team is requesting that I consider doing more of these after we come out of COVID, that I don't insist on face-to-face meetings, but I make it an offering. I'm very, very big on meeting face-to-face, whether it's video face-to-face or actual face-to-face. So I'll probably, it's really interesting because so many more people are interested in video conferencing, grandparents with their grandkids, family functions, Sunday, Easter Sunday with the whole family. So this is becoming commonplace and really feeling more comfortable. So I had a meeting with an elderly couple, well, not elderly, but in their late 50s right before this, and they are in Columbiaville, and I'm in Shelby Township. So we had a great meeting this evening. So
and it
yeah.
also allows us, it allows us to, we would not be able to be pushing this out, at 8 o'clock on a Thursday, which is very cool too. So it's allowing us to give information to the public too, which is awesome. And shameless plug for those of you who are watching or will be watching on my stream. I've been working with Dawn for, I think, close to 5 years. It's unbelievable. Just not only, a wonderful lender, wonderful person, great rates, a really flexible set of programs, which has been awesome, and a great team behind her, which is fantastic. So definitely give her a shout if you're looking to check something out. So I know we're a little bit over time. Thank you so much, Dawn, for having me on. I appreciate it.
You're
always
awesome.
A blast to do content with you. You can also check out, Dawn puts out killer videos on her YouTube channel or on her Facebook page. You can also check out my YouTube channel, just search either or. And you will also see that Dawn has been on my channel before, and we've got some, if you are really worried about it, last thing, I will send out the link. Dawn actually came in, we did a podcast on why we're not looking at another 2008. So if you're worried, I don't think we're going to have another 2008. I'm not worried about it at all.
Love it.
Some great reasoning for that. So thank you so much. Thank you everyone out there for watching. Love all you guys. Stay safe. And just let us know if you need anything.
Cool.
Thanks for watching.
Thank you.